Hello, ladies and gentlemen, and welcome to our interview with Kristian Marquez. Kristian is the founder and president at FinStrat Management. With decades of knowledge from his senior roles in accounting and investment management services, he founded FinStrat Management as an outsourced financial operations firm with serving B2B SaaS companies, investors, and VCs. Kristian, thank you for joining us for our risk management show recording today.
Boris, it's a pleasure to be on. Thank you for having me.
Absolutely. Kristian, could you tell us a short story about your career path? What brought you to where you are right now, and what you guys at FinStrat Management up to these days?
Absolutely. So my professional career now spans 25 years. After getting out of the U.S. military, I started my career in investment analysis. So this is near the turn of the century. It was at this time that I got exposure to portfolio management, specifically short-term trading, but also macro value investing. Those earliest origins helped shape my view of risk return. I subsequently held a handful of financial operation related roles at registered investment advisors. So these are businesses that advise high net worth individuals as part of their portfolio management strategies. And around this time, I achieved my CFA charter, so internationally known designation with an emphasis on investment analysis. Next year will mark 2 decades as a charter holder. But I ended up at the time getting hired as a financial analyst at a small consulting firm. The CEO was a go-getter. And over the subsequent 9 years that I was employed there, we went from early stage to a 4.4 billion with a B IPO a year after I left.
Wow.
I had a material hand in helping to build the business. In fact, I started an intra business within that company, taking a new product line from 0 to $80 million in reoccurring revenue in 2 years' time. Thereafter I left, I co-founded a telemedicine startup with 2 board certified physicians, raised 2.5 million pre-revenue, spent it all and had to close the doors. So learned a lot of what not to do the next time I find myself in that position. But then I started FinStrat Management, which today, as you mentioned, I'm the founder and president of the company. And January will mark our 7th year of operations, whereby we're really fortunate. We get to work with founders. So today's entrepreneurs and innovators, heavy emphasis on software, but more generally, these are venture-backed companies. But then we also get to work with angel investors as well as venture capital firms.
Fantastic. So based on your experience, I believe we will have a very thoughtful conversation on the topics of actionable advice for financial growth, planning, analysis, and maybe some tips, path to profitability, steps for business owners at every stage. So I think it will be very exciting. So, Kristian, as a seasoned CFA charter holder, what actionable advice can you offer to individuals and business when it comes to effective financial growth planning and analysis? Of course, I think it's very kind of generic question, but maybe you can put it in perspective to your most clients, which are mostly B2B SaaS companies, right?
Sure. I mean, I'll answer the question, through the lens of being in the United States, but more broadly, I think there's a lot of carryover to businesses, regardless of where they're located. So, today, because I work with early stage venture-backed companies, the space has historically had the mindset of growth at all costs, even if it means you're not profitable. And the logic was is that if a founder has a winner on their hands, they can always go out and raise additional equity financing to propel the business forward in advance of a sale or an IPO. However, with the Federal Reserve's decision to start raising rates last year, now to a nearly 2-decade high, the landscape has absolutely changed. And it's really important because if you think about where rates were near zero, investors were able to take more risk because their options were just less options of where to invest their capital. Now that that's changed, investors, whether it's early stage companies or venture capital firms themselves, now have more choices. And frankly, they from where I sit, they look at early stage businesses as frankly a discounted bond that matures in 7 years, because historically, on average, that's how long it would take an early stage business to monetize, notwithstanding a secondary option, a secondary where existing shareholders would have the opportunity to sell their shares. And so I think it's really pertinent, because if you're a founder today, you need to be thinking about profitability, because there is less liquidity, or at least investors are going to be more discerning on the decision to write a check. And so what does that mean practically? Well, if I oversimplify a profit and loss statement, we have revenue and we have expenses. The difference between the two creates net income, or i.e. profitability. And so if I'm a founder today, I'm placing a very heavy emphasis on revenue, first and foremost. So in any, closing deals, but also ensuring that any money that I'm spending is assisting with the top of the funnel, getting potential purchasers in the door so you can close them. The second part of that, the expensing part, if the company is going to be profitable, you really have to ask, is this spend a need or a want? And it's not to say that historically non-profitable SaaS companies are spending money on wants, but I genuinely believe today that you have to really ask the question, do I need to spend this money today? And if I do, is it going to generate a return? And so part of what we do in our business is we place a heavy emphasis on metrics. One of the metrics that we look at are customer acquisition cost payback period. So what's the amount of dollars it spends to acquire a customer, and then how long will it take you to recoup that cash? Generally speaking, we want to keep that under 12 months. Anything over that poses a challenge, in so much as it requires a larger cash runway. In addition, we'll also look at return on customer acquisition cost payback. And so the idea here is, how much revenue does an individual client lend? And you can create a range of ROI, but unless you're creating $3 for every dollar you spend, I think you need to reassess where you're spending your sales and marketing dollars. And that's just tip of the iceberg. A lot goes into discipline, a lot goes into planning, the ability to forecast, because most businesses operate in a dynamic environment where things change. I mean, if you hit your numbers and you have to hire more staff, that's going to have a direct impact on your runway. And so it becomes a multivariate formula where there's an emphasis on sales, there's an emphasis on delivery, but all the while keeping an eye from a planning perspective. And then, just coincidentally, that's what we do. Today, we bring fractional chief financial officers to our individual client implementations. We create budgets, models, forecasts to help answer that question. And we find that the CEOs who have the best handle on their business are the ones who really dive in with us and understand the mechanics of what makes their business tick from a financial perspective.
Right. So can you explain the concept of path to profitability and how it applies to business owners at different stages of their journey? What are
absolutely.
the steps?
Yeah, so it's definitely an evolution. So a couple ways to think about it, and I actually have some very strong opinions on this. So if there's consensus that profitability is good, one of the questions that we should ask is, well, what's the quickest way to get to profitability? Historically, notwithstanding the fact that people weren't becoming profitable, they were just continuing to do additional priced equity rounds or debt financings. If we think about it, we're really just answering the question, can we get people to give us money for what we have, in simplest terms? And so on day one, my sense is that there's a tremendous, depending on what's being sold, there's a tremendous amount of discovery that needs to take place. And so you often hear about companies having to pivot a year or 2 years in as they figure out what it is that they're selling. I am now of the opinion that pivoting is good, but I'm to a point, I almost feel as if founders are better served starting a business where the probability of achieving profitability is a lot higher. Example, my own company, FinStrat Management. Today, I'll oversimplify it, but we sell accounting and finance reporting services. We've been profitable since the first day of our business because everybody knows what accounting and finance is, and there's no shortage of businesses who require our service. And as long as we continue to make investments in our people and our process, our technology, I found that our business continues to grow. But if you think about it, what it's done is it has positioned a company like our company to now say, okay, I have an idea for a product. It's a new product. I'm hypothetically speaking, but I'm making my example. It's a new product. But now I have an underlying financial foundation where I can take risk. Because if I'm wrong on my product, I won't go out of business because I have my existing accounting and finance business to support this. And so historically, this has been consulting. You'll see a lot of founders are experts in their field, and they'll start by consulting. I mean, that's a parallel, another great example. But you can extrapolate that to any professional service type business where we know that there's demand for the service, and as long as it's priced right and you can hustle and pick up new clients, it sets this foundation. And so as part of this trajectory, today my counsel is before you just start a brand new business like I did with the telemedicine company, so effectively zero revenue, and here I am having to make sales in order to cover my minimum infrastructure. I'm now of the opinion start with an existing business that will generate profit and then transition over. And presuming you take that approach, it takes a lot of pressure off of having to compromise on features and functions. It takes pressure off of having to compromise, or it takes pressure off of having to hire less than incredible staff, because I think people are a big part of a company's success. But that said, are there times where companies want to operate break even or in the red? I mean, the answer is yes. It just goes back to what I mentioned earlier: is how big is your runway? If a company has 2-year plus a runway, and you're faced with a significant market opportunity, I can make a case for spending a lot more on sales and marketing, even if it means the company goes in the red, because I can always throttle back my spend and get back to at least break even or better. And so it's not an absolute. Said another way, it's not an absolute in my mind by any means. It really is dependent on circumstances, and sometimes you have to strike when the opportunity presents itself.
Interesting, yeah. I saw a lot of companies starting with some consulting services, and then just this is bring a constant revenue stream, and then they bring a new product, and then become kind of SaaS companies. Yeah. As myself, I was a consultant, and I used to work as a risk management. But then I discovered by chance this risk management community, and apparently I was able to produce revenue by advertisement. But I never been a marketing person, so I by kind of appending my income with advertisement, I was able to grow this community, and now I almost never go to assignments, just do my business. Yeah, but let's
Great
discuss.
example.
Let's discuss some how do you tailor financial strategies to different business owners, because they have unique financial needs, and how can they tailor their strategies, for example, to match to special industry market conditions, and you just mentioned that the interest rates and how in the different growth path.
That's a great question. And very fortunately, it's a straightforward answer. And it's actually, the answer is, in my opinion, is consistent, regardless of what business you're in. So I don't know if you remember when you were a kid, and we would get like a maze. And I don't know about you, but I would actually go to the end of the maze and I would draw the line backwards to figure out how to solve the maze. Well, financial planning is somewhat very similar. We're going to ask a question, what's your intent with this business? Generally speaking, though there are exceptions, founders want to sell their business. They want to monetize. And so I'll begin when I have my fractional CFO hat on, I'll ask the question is, well, when do you want to sell this business by, and for how much? I can get more sophisticated, and I can say after taxes, how much would you like to see in your bank account? But depending on the answers to those questions, we can then walk backwards a model for revenue. We have a sense of what month over month growth expectations we should have. We know we can estimate how much a company should be spending or should expect to spend on cost of sales, product development, sales and marketing, general and administrative expenses, just based on industry benchmark. So if we know where they are today, we know where they want to go, we can estimate multiples on a sale. We can then create a financial model that says, this is what you need to achieve, founder, in order for you to pocket 10 million, 100 million, $1 billion in cash in your personal bank account. And it becomes a really valuable exercise because it will identify if there's a mismatch in expectations. So I'll exaggerate to make my point, but if a founder starts a company tomorrow and says within a year they want to sell the company for $1 billion, well, you better have a very unique product. These days it's going to be something that's artificial intelligence related, that is going to position you to be able to do that. But the reality of it is, it's going to take years to get from concept to a sale. And happens all the time. But that's how I would start answering that question. Where do you want to exit and when? And then we walk backwards and we can create a full model with all the detail. And we do that regularly.
All right, fantastic. Yeah, because we are a community for risk managers, and I would like to ask you, because in the risk management is crucial aspect in financial planning. What advice can you offer to business owners to identify, assess, and mitigate financial risks effectively?
Yeah, so the biggest one top of mind, and I'm sure you probably spoke about this on some of your previous or more recent podcasts, is treasury management. And so, all businesses fail for one reason and one reason only: they run out of cash. Okay. And so when I think about risk management, first and foremost, is the company in possession of cash? And so, you can think of it two ways. One, just operationally, we touched on this. Do you have a budget, and are you charting a path where the company is going to be profitable, or at least break even, i.e. not run out of cash? But two, given what's taken place with Silicon Valley Bank, so
Mhm.
I'm not an expert on the subject, but in simplest terms for your listeners, there was a mismatch between the liabilities, so effectively the deposits, and the asset interest rates that they had purchased to create a spread, and so that duration mismatch created a really big problem for the bank. And so, notwithstanding what anyone thinks of the U.S. government, the decision, in my opinion, to make all of those depositors whole was the right one, because a significant portion of the U.S. Innovation hub was banking
Yeah.
with Silicon Valley. That said, even before March, when the bank failed, we provide our clients guidance on having multiple bank accounts. Preferably, one of them is with one of the large 8 banks that the Federal Reserve includes in their large bank program. There are other opportunities to use sweep programs, where most banks these days will give you the ability, if you have a balance over $250,000, to spread that off across multiple banks for a minimal fee. And then if you really want to get into the weeds, there's a program called Treasury Direct, where the U.S. Treasury will sell Treasuries, bill, notes, bonds direct to purchasers, whether they're individual or businesses. There's some restrictions in terms of size, but in my experience, most individuals and businesses don't exceed those thresholds, and if they do, you can just participate in multiple auctions if size was a consideration. But those, in my mind, are the big ones. It's not only ensuring that your budget and your ongoing forecast conform to your cash profile, but today, big emphasis on safeguarding cash and ensuring that it's there to be able to run the business by employing one or more of those tactics I just outlined.
Yeah, cash is still the king. Right. Kristian, I would like to ask you a personal point of view. What is the major misconception in the field of your field of outsourced financial operation services, and you that you kind of strongly disagree with?
Oh, wow. So I would say that probably the biggest contention is going to be on forecasts. For better or for worse, and I'll explain my position. An argument can be made that forecasts are generally too optimistic, and so I think a lot of investors will discount forecasts, especially if you think about the further out a forecast, like a 5-year forecast. I mean, how no one has a crystal ball. Most forecasts are linear. And to presume that there won't be macro events that influence a forecast, I mean, it just doesn't seem reasonable to me. And so a case can be made that on average, whenever an investor looks at a forecast, that they should frankly discount it, whether that percent is 5, 10, 15, 20. I don't know is as important as just the concept of take it with a grain of salt. My position is I appreciate why some founders are going to publish a optimistic forecast. And my sense is it's because they genuinely believe in what they're doing and think that they'll be able to capture as much of the market as they're projecting. Now, whether they're right or wrong, there's another benefit of that, and it's just being an optimist. And so I've never profiled and I've never surveyed founders, but I'm willing to bet a nice dinner that if we did, we'd find out the majority of them are optimists. And so here are people who genuinely think that the world can be a better place. And if a consequence of that is that we're going to have higher forecasts, well, I can live with that. because we need more innovators. We need more entrepreneurs. They create the jobs. They create a lot of the fantastic services today that have just multiplied productivity 1,000-fold. And if it wasn't for the fact that they believe in the future, I'd argue that we wouldn't have it as good as we do today.
Absolutely. All right, great answer. So if I summarize our interview, so for someone who is listening, who would like to walk away with one or two major takeaways, what would it be?
First and foremost, there's no substitute for someone handing you cash for what you have. Meaning, all the logic in the world doesn't make a difference until the cash is in the bank. I say that from direct experience, and just from what I see from working with our clients today. And so, if there's a way to minimize the risk associated with finding out that answer by consulting or providing services, I absolutely encourage you to do it. I think it'll increase your odds of success, but it also takes pressure off individuals mentally, because it's very stressful to start a company, especially if you're married or have children or have fixed payment obligations like a mortgage or car or school that you have to deal with. So that would be one. Number two is, and Boris, I admit I'm biased, but I personally see a tremendous amount of value in financial planning. I think of it like as if we were to build a home. We wouldn't build a home without plans. Why would you attempt to, push a business forward without a set of financials, whether it's a budget or forecast?
Fantastic, Kristian. That were all my questions. Perhaps if I forgot to ask you something that you would like to kind of tell to our audience that will benefit them, please go ahead.
Yeah. Again, thank you for having me on. If any of your listeners would love to get a hold of, maybe they can do so at our website. It's FinStratMGMT.com. So that's Fin short for financial, Strat short for strategy, MGMT.com. If they want to go on LinkedIn, they can find me there as well. Just shoot me a note, say they heard us here, and I happily accept. And would love to meet anyone who's also interested in these subjects.
Absolutely. Thank you again, and I wish you and your company a great success. And I hope we will come back to discuss another topic in a few months, because you are one of the top consultants and specialists that I think our members require services like you do in lot of cases.
Boris, thank you again. I appreciate you having me on.
Absolutely. Thank you. Bye-bye.